going to share my screen. Okay, and we're going to talk about a common belief, a common question, something that's commonly, told to retirees, that when you enter retirement, your taxes are going to be lower. Your income is going to be lower. So ideally, while you're working, you want to defer as many taxes to retirement as possible, because again, if your taxes are going to be lower, you're better off paying in retirement than you are paying while you're still working. And so this is a common adage that we're going to examine today. We're really going to dig deep on and really question that, again, kind of rule of thumb, common adage. So is this true? Will taxes actually be lower in retirement? And it's a little bit more complicated than you might think. In some ways, yes, your taxes will be significantly lower. Okay. In other ways, however, the taxes that you're paying on your last few dollars will be higher. And it's almost those last few dollars and what that tax rate is that, depending on, again, what we're planning around, matters even more. Okay. So again, in general, your overall tax rate and therefore taxes paid will typically be lower. So for instance, when we look at the total taxes paid relative to your income, on average, I will say the average retiree will have, again, lower taxes than they did in retirement, or while they were working, I should say. However, this doesn't tell the whole story. And if you just focus, and I see I got a misspelling there, grammar mistake, but this doesn't tell the whole story. And if you just willy-nilly go into retirement thinking that at every point in retirement, my taxes will be lower, you will likely have a rude awakening later into retirement. Okay. So there's kind of two key tax definitions that I want to go over right off the front here. Okay. The first one, and I'm just going to make sure. Okay. I am live still. Okay. Awesome. The first one we're going to talk about is your marginal rate. Okay. And then we're going to talk about your effective rate. Okay. So let's go through an example. In 2020, John had a taxable income of $84,000 a year, and he paid, let's say, $11,200 in taxes. And I'm just kind of pulling that out of the air. It's not like it lines up perfectly, but again, just pulling that out of there. So he's a single filer. Okay. So at first he's taxed at the 10% bracket. He's taxed at the 12% bracket. And the last, again, we see down below here on this timeline, if you will, or this dollar line, that the 22% bracket takes place from $39,475 up to $84,200. Okay. And so his taxable income is within that $84,200. So his last dollars are essentially taxed at 22%. Okay. And so when you often hear marginal rate, your marginal tax rate thrown around when we talk about taxes, that's essentially what that means. What are your last dollars taxed at? So in this example, John's marginal tax rate would be 22%. Okay. Effective tax rate is typically what most people mean when they say when your taxes are going to be lower in retirement. They're talking about the effective tax rate. Okay. So for instance, of that $84,000 of taxable income, John paid, again, in the 10% bracket, he paid in the 12% bracket, and then he paid in the 22% bracket. Well, each of those taxes, again, have that different rate. So when you add all of those together and divide by your overall taxable income, that gives you your effective tax rate. So it's basically how much income did I actually get? Or how much did I pay in taxes divided by how much income did I actually receive? And so in this case, 11,200 divided by 84,000 is 13.3%. So your marginal tax rate will always be larger than your effective tax rate. Okay. Your effective tax rate, again, because you're paying in lower brackets, will be lower. Marginal tax rate will be higher. And so when we're tax planning in retirement, we just can't look at the effective tax rate and think that, oh, okay, so my effective tax rate is going to be lower than it was while I was working, so I should defer all of these taxes to retirement. The reason being is because I would argue your marginal rate matters more. Okay, because your marginal rate is essentially where you're going to end up. So basically, if there's a way, let's say this let's say John was being pushed into the 24% bracket. Let's say he needed $90,000 of income. Well, when we're tax planning in retirement, the reason your marginal rate matters more is because as we're taking withdrawals from your retirement portfolio, we want to avoid high marginal rates. So in this example, let's say he's taking $90,000 of retirement income or of taxable income. So he's in the 24% bracket. We might want to take from Roth assets in order to avoid the 24% bracket. Okay, if we can stay in the 22% bracket for his entire retirement, we have enough Roth assets to do so. We want to avoid that extra, 2% tax, essentially. Okay, this is why your marginal rate, again, oftentimes matters more when we're talking about annual and forward-looking tax planning. Okay, and so again, your effective tax rate will often be lower. Your marginal tax rate can often be higher in retirement than while working. So again, most people, when they think of this adage of taxes being lower, they're focusing on effective tax rate. I want you to start to rework your brain and think about marginal tax rate, because it's going to affect decisions that you make while working. Okay, and we're going to show a bunch of examples why that is. Okay, and again, here's why your marginal tax rate matters more. Depending on what buckets you're in while you're working versus buckets you're in while you're in retirement, again, it will affect these decisions. Okay, so we want to avoid, obviously we want to avoid the 32, 35, 37%, and we want to harvest income at these lower brackets. Okay, but we're also going to talk about how, these, what would that be, 7 buckets here don't exactly encompass all of the marginal tax rates that that you'll be subject to. The reason being is because there's certain tax hurdles and tax traps that are created in retirement that we're going to talk about. Okay, so if you believe this adage, what ends up happening? And I see it all the time with with other advisors when they're kind of recommending what a client should do while they're working. It's always, look, you're going to be in a higher tax rate while you're working than you will in retirement. So contribute all of your money essentially to tax deferred accounts. You gain a tax break in the year that you contribute. And then in retirement, you'll withdraw at a lower rate. And again, this makes sense intuitively on the surface. And so what we often see is, again, this is just an example, but we see the majority of someone's money in IRAs, in 401ks, in these tax deferred vehicles. Okay. And they have very little in Roth. They have very little in brokerage accounts. And so they have all of this risk essentially in this one tax bucket. And so ideally we want to have some diversification, not only amongst investments. We all know that we don't want to put all of our eggs in one basket, but we also want to have some tax diversification as well. I'm just going to make sure we don't have any questions that are coming through as well. Okay, awesome. I seem to still be live. So hopefully the Zoom Facebook issue got fixed. Here's kind of a sinister secret that it's easy to miss. Most people don't readily think about it, but in the industry, we see it a lot. Okay. And I think part of this adage of you're going to be paying less in taxes in retirement was created by the financial industry. And they have an incentive to have clients contribute essentially all of their money to tax deferred vehicles. And why would that be? Okay, well, if you put money into a brokerage account or you put money into a Roth account, the dollars that you put into those accounts, you have to pay taxes on first. Okay, so let's say your marginal tax rate is 22%. You put $1,000 in, there's going to be $220 that comes right off the top. So you're only going to get to put $780 into a Roth or into a brokerage account versus you can put $100 into an IRA. Well, think about how advisors are paid. Okay, advisors are generally paid off the assets that they manage. Okay, whether it's a tax deferred dollar or whether it's a Roth IRA dollar. Okay, so essentially, advisors telling you to contribute all of your money to tax deferred accounts are gaining essentially that extra tax benefit in fees. So for instance, if you put that $1,000 in a tax deferred account and they're charging you 1% a year, they get 1% on that $1,000. If they tell you to put it in a Roth account, they get 1% on $780. Okay, so over time, this grows to be a big gap. So again, maybe I'm a little bit negative on this, but I think there's a sinister secret behind this adage. And I want to make sure you don't get caught into it. And again, we're going to show a bunch of reasons why that just trying to put all of your money into an IRA, even though you get that tax break, isn't the best idea as you move through retirement, or at least creates a tough situation as you move through retirement. So what are some reasons your effective tax rate is typically lower in retirement? I'll say the number one reason is Social Security. Okay, and it's a highly undervalued asset. Hopefully, if you've been in this group for a while, you've seen all the Social Security videos that we've put out, that Social Security is actually one of your most valuable assets. Okay, and it's one we're required to contribute to. So why not maximize and get the most out of that benefit when we're required to contribute to it? Okay, it's sitting there, and it's up to us whether we maximize or minimize. And it's a tax preferred asset. So at the very most, Social Security is only 85% taxable. Okay, every dollar you pull from your IRAs is 100% taxable. So there is a tax benefit, even at the most extreme part of Social Security's taxability. There's a tax benefit to having a dollar come from Social Security versus pulling a dollar from your 401k or your IRA. Okay, so that's the number one reason I will say, just across the board, taxes are typically lower in retirement. Another big one is typically you don't need as much, or you don't need as much income while you're retired than you did while you were working. Okay, this makes pretty good sense. Even if you plan on traveling a bunch in retirement, your income need will likely be lower. The reason being is because while you're working, you're contributing into a lot of expenses. First off, working, commuting, those require expenses. The big one though is, you're not contributing to retirement anymore. Okay, so if your family is making $150,000 a year and you're putting $20,000 away into retirement, well, that's $20,000 right off the top that you can at least lower your income by. Okay, and again, there's some other expenses too that just lower income just in general than while you were working. Not all income is taxable or taxed at the same rate. Every dollar that you make at your job is taxed at the same rate. It's a federal income tax, state income tax. Okay, well, you can pull money from a Roth IRA in retirement and pay no tax. You can pull money from a brokerage account and pay long-term capital gains. So not everything is taxed at the same rate. That offers some fantastic benefits in order to save on taxes throughout retirement. Another big one is some retire into a lower tax state. Okay, there are certain states that don't have any income tax. Okay, there are some states that have that don't tax Social Security at all. Wisconsin's one of those that doesn't tax Social Security. There's most don't. But nonetheless, retiring into a state that doesn't have any state income tax will obviously save on taxes. And then certain expenses, certain taxes are no longer present as well. So again, on average, your effective tax rate will be lower. Okay, but let's go through some. Let's actually dive deeper into some of these reasons. So, for instance, let's look at Social Security. Just a quick example. A bunch of you have probably seen this before. $84,000 of income need. Okay, if you're taking it all from IRAs over here on the left, you're going to owe $6,650 in taxes. I believe this is for a married couple based on 2020 taxes. Just looking at federal income taxes. Okay, if you have a Social Security benefit, you take Social Security at 62, therefore receiving a permanent penalty for doing so means you're going to be taking $50,000 from your IRAs. And notice you will pay a little bit less in taxes. The reason being is because a portion of your income is coming from Social Security. But look what happens when you maximize Social Security. Okay, rather than 32, you have $56,000 coming from Social Security over here in the right-hand column. Far less is coming from your IRAs, and we see a huge tax savings. And so again, this is the number one reason that your taxes will be lower in retirement. Okay, so perfect. See, taxes will be lower, case closed. Just keep contributing to IRAs. There should be no issues, correct? Well, obviously, there's more to this story. Otherwise, I wouldn't have created the rest of this presentation. Okay, so I want to walk through some reasons why your marginal rate, and why your marginal rate's important to be looking at, but number two, why your marginal rate will be higher in retirement, and again, why this matters more. Okay. I had an unstable internet connection there, so just want to make sure everything's still going. Looks like it is. Awesome. Okay, so Social Security on average will save you a lot on taxes. Okay, but it's a little bit of an ironic situation because it can also raise your marginal rates higher than any current federal income rate right now. So the highest federal income rate right now is 37%. Okay, well, I'm going to show you why your marginal rate when you're planning around Social Security can actually be higher and why you want to avoid that. Okay, so this is how Social Security, it's determined how Social Security is taxed with this formula called provisional income. So you take your adjusted gross income, this would be money from pensions, IRAs, okay, annuities, it would be capital gains. Okay, really the only thing that isn't included in your adjusted gross income would be Roth IRA withdrawals. Okay, then you would add in tax exempt income, that would be things like muni bonds, and then 50% of your Social Security benefit. Okay, so let's say that we're taking $70,000 of retirement income, 40,000 is coming from Social Security, 30,000 is coming from our IRAs. Okay, so we would take 30,000 plus half of 40,000. So we would get a provisional income of 50,000. Okay, if we were married, we plug this, or regardless of if we're married, we plug this provisional income number into this table right here. If we're married, if we have less than $32,000 of provisional income, Social Security is tax-free. Between this zone of 32 and 44,000, up to 50% in this zone is taxable. Okay, so if you have a provisional income of 44,000, just 50% of this zone of your Social Security benefit will be taxable. So there's $12,000 in this zone, 50% of that is 6,000. So if you have $44,000 of provisional income, just $6,000 of your Social Security benefit will be taxed. Okay, above 44,000, up to 85%. So every dollar that you have over 44,000 for your provisional income will cause 85 cents of your Social Security benefit into becoming taxable. So let's step back a second. What is this? This creates a situation where a dollar you take from your IRAs will cause your provisional income to go up by $1. It will also cause you to be taxed on Social Security at 50 cents or 85 cents from that dollar. Okay, so this is basically what it creates. Okay, we have your expected tax rate. That would be, again, what people think your normal, just basic tax tables would look like. So 10, 12, 22%, 24%, et cetera. And then we have your actual tax rate there in red. And notice your actual tax rate is 50 to 85% higher. Okay, the reason being is because as this person takes income, it's causing more of their Social Security benefit to be taxed. They're essentially being double taxed. Okay, and so let's say that, and this, just to step back for a second, this is going to be unique for everybody. Okay, this table right here, it's not a boilerplate, so you can certainly screenshot it, but it's not going to be something that will apply to your situation. It's going to be unique to everybody because everybody has a different Social Security benefit. Okay, so basically this will be your marginal rate. Whatever your last dollar is taxed at will be your marginal rate. So let's say that this person is taking $35,000 from their assets. We can follow this up the y-axis and we see that they're going to be taxed at 40.7%. Okay, so we see that this tax trap creates a situation where it's higher than any federal tax rate that we will see. 37% is the highest, and you have to make hundreds of thousands of dollars to be taxed at 37%. But notice just at $35,000 of withdrawals from this person's IRA will have them taxed at 40.7%. Okay, so this is why it matters. As you're, in those last few years, as you're working and still contributing to your assets, start thinking about what your tax rate is going to look like in retirement. Because ideally, if somebody has, let's say somebody has $1.5 million, but it's all in 401ks. Okay, if they need this $35,000 of income on top of their Social Security benefit, they're forced to enter into this tax trap. Okay, so yes, overall, their effective tax rate, even with this tax trap, might be lower. But my point is, the $5,000, if they took the last $5,000 that they took was taxed at 40.7%. So ideally, they would have wanted to have Roth assets or savings that they could have taken from in order to avoid this trap. Okay, because again, that's a higher rate than they ever paid before throughout their working career. Okay, and so what happens here in this tax trap? Let's say they're in the 22% bracket and they withdraw that $1,000 extra. Most people would think they owe $220 in taxes, and they do, but they also owe additional taxes. Okay, they owe that $220, 22% of 1,000, but it also causes $850 to become taxable. That's also taxed at 22%. And there we get that $470 on a $1,000 withdrawal, or 40.7%. Okay. So again, why does this matter for tax planning? I've kind of already alluded to it, but basically we need to know what our tax picture looks like in each year of retirement. Okay. And this is it seems like a complicated concept, this tax torpedo, and it is. It took me, I don't know, I had to read through these rules and kind of do the math on my own 10 different times in order to understand this tax table. Well, this is the most basic, version of the Social Security tax trap that exists. Okay, there are other, when you add in capital gains, okay, this tax trap gets more complex, and you'll see higher rates as well. So why does this matter for tax planning? Again, because as we move through retirement, we want to know what those last dollars are taxed at. Okay, we want to avoid every dollar that's taxed at 40.7%. We might even want to avoid every dollar that's taxed at 22.2%. Okay, if we have the ability to avoid all of this tax trap here, and I'm just going to get out a writing tool, just because I'm sure I'll need it at some point. So this is where basically the tax trap starts and the tax trap ends. Okay, if we're able, we might want to avoid this whole part of the tax trap. Now that will require Roth assets. Okay, that will require very low IRA balances, because later on, if you avoid this for a few years, and then later on you get hit by RMDs and it forces you in here, then you can't do anything about it. So if we can avoid this, though, we might be able to only avoid this part. Ideally, we might be able to, or depending on our assets, we might be able to avoid it all. But we need to know what these brackets look like and what those dollars, those additional dollars that we take, are going to be taxed at. Okay. Okay. Another reason your marginal rate might be higher is because different withdrawals have different tax rates. Okay, and how these work together again can bump you up into a higher marginal rate. Okay, so just in general, your income is stacked in the eyes of the IRS. You don't get to pick the order. Okay, the order is already laid out. Okay, it's basically laid out in the most optimal way, so you don't really have to worry about picking the order. But it starts with IRA withdrawals, or it just starts with normally taxed withdrawals, I should say, whether that's pensions, annuities, IRAs, things that are fully taxed based on income rates. Okay, so that's going to be basically your base. Okay, on top of that, if you have any long-term capital gains, that's going to be stacked on top of that. The reason that's good is because capital gains have a preferred rate. So you want those last dollars to be taxed at a preferred rate rather than a higher federal income rate. And then finally, Roth withdrawals, and those aren't taxed at all. So those go on top and really don't affect your tax situation. Okay, so the combination of these capital gains and normally taxed withdrawals, if you're not careful, can create an unexpected tax hike. Okay. And again, just to lay this out, I believe these are old tax tables, so don't worry as much about the exact dollarized numbers over here. But I think it shows a good way to look at what the income tax rate will be at a certain level, and then what your capital gains rate will be. So for a single filer and a married filer, basically underneath 40,000 for a single and 80,000 for a married, you'll basically be in a 0% capital gains rate. Okay, above that, let's say that you have $100,000 of taxable income in a given year, and you need $5,000 more of income. Well, if you take it from your IRAs, you're going to be taxed over here at 22%. Okay, if you're married. But if you take it from a taxable account, you have capital gains. Okay, you're going to be taxed at 15%. So there's some games that we can play in a given year in order to lower your overall tax rate. Okay, but also, let's say that you're in a 0% rate. Okay, but you're not exactly sure of what your tax tables look like, and you take out additional withdrawals that push previously taxed capital gains at 0% into being taxed at 15%. So what will that do? Well, it will again create a little bit of a tax trap, because $1,000 withdrawal will push not only $1,000 into being taxed, but might also push capital gains into being taxed that wasn't previously taxed. So that marginal rate on that extra $1,000 will rise. Okay, so let's look at this in terms of the Social Security tax trap. Okay, and this is what I mean when it can get a little bit more complicated. Okay, so this person was at a situation where they were right on the edge here. Okay, and they needed $1,000 extra dollars. Okay, so they basically thought, I'm going to have, I'm in the 12% bracket, I'm going to owe $120 on that $1,000 withdrawal. And once again, they are right. They're just not looking at the whole story. Okay. Well, they had some long-term capital gains that if they wouldn't have taken an extra $1,000, they wouldn't have owed any tax on those long-term capital gains. But because they took that extra $1,000, it pushed their capital or their taxable income up, and pushed them up enough that their capital gains are now taxed at 15%. Okay. And so what did this do? Well, they did owe $1,000 or 12% on $1,000. So they owed $120 there. That $1,000, just as we showed previously, pushes $850 of their Social Security benefit into being taxed at 12% as well. But that adding those two together, okay, that $1,000 withdrawal and then $850 of extra taxable income causes $1,850 of their previous capital gains that was taxed at 0 to now be taxed at 15%. Okay. And so essentially this creates a situation where this person owes $499.50 on a $1,000 withdrawal. Whoop. Okay. Which is 49.95%. So this person thinks they're paying 12% and they're paying 49.95%. Okay. And so again, this is why your marginal rate in retirement at different points, if you're not careful, will likely be much higher than any rate you ever saw while you were working. And so again, this makes a case for having a more diversified balance as you move through retirement, to be able to, again, I use the term play games. I don't mean as far as you're actually playing games, but I mean, there's some different techniques that you can use, obviously. Rather than taking from IRAs that extra $1,000, you would rather take from Roth. Okay. So another thing that I often try to tell retirees is tax rate matters. Okay. We often talk a lot about tax rates, but taxes at the end of the day are just another expense. Okay. And if we just back out a second, look at more of a bird's eye view of your situation, we should be thinking about expense rate as well. Because again, there are certain tax penalties or certain penalties based on your taxable income that will add to expenses. Okay. So let's say that you're retiring before 65. You can have some kind of continuation from work. Income doesn't matter as much if you have some kind of continuation from work. The trade-off is it's typically a little bit more expensive because it's not subsidized anymore by your work. Okay. Or you can enter into Obamacare, Affordable Care Act marketplace, the public marketplace. Okay. And costs in the public marketplace are tied directly to your reported income. And the equation is pretty simple. The lower your reported income, the larger your subsidy. Okay. So basically this subsidy will phase out the higher, the more you report for income. And for the next 2 years, because of the American Rescue Plan, this cliff was eliminated. However, for there on after, this cliff will come back. So now, rather than a cliff, it's much more gradual for the next 2 years, but this cliff is coming back. Okay, and so I'm going to talk in terms of this cliff just because it makes the math and kind of the illustration a little bit more simple. And this cliff is going to come back for the long term anyway. Okay, so basically on one side of this cliff that we see right here, okay, you will earn a subsidy. Okay, and the subsidy is typically pretty big. It'll vary person to person, area to area. But let's say on one side of this subsidy, you get a $500 subsidy. On the other side, you lose that $500 subsidy. Well, that's a $6,000 subsidy that you lost for making essentially maybe $1,000 over this cliff right here. Okay, so it again drops off like a cliff. You owe an extra $6,000. Well, I want you to start thinking about that extra penalty as an additional tax. Because again, if we take $1,000 out and we owe $6,000, that's a pretty steep tax, okay? It's a 600% tax, okay? And so let's walk through an example. Tim is aiming for a reported income of $50,000, okay? That will earn him a subsidy. At the end of the year, and now Tim is single, by the way. At the end of the year, he forgets he has to take an RMD. He inherited an IRA from an uncle that passed away, and he has to take an RMD from that inherited IRA. Okay, that RMD is going to be $7,600. Okay, now he didn't readily think about that. He got a letter from his custodian at the end of the year and thought, oh crap, if I miss that RMD, I owe a 50% penalty. So I better take that RMD. However, he had set his reported income to be $50,000. So this RMD essentially is going to throw his healthcare situation into a mess. Okay, so without the inherited RMD, basically what Tim was planning on was he would have a reported income that would earn him a subsidy. That subsidy will allow him to just pay $600 per month for his health insurance. This would correspond to a $1,200 deductible and $3,600 max out-of-pocket plan. Okay, and so when we think about subsidies as well, that subsidy obviously helps you on the premiums that you pay, but it also helps you with a lower deductible and a lower max out-of-pocket plan as well. And so if you do need health care throughout the year, having that extra subsidy will help you on the back end too. Okay, it'll help you in multiple ways. With the inherited RMD, this should say, let me cross this out. With the inherited RMD, Tim's new income lost him the subsidy. Okay, because he made over the mark for a single filer that he no longer got the subsidy. Now he owes $1,100 per month for his health insurance, an extra $500 a month. He had a $2,400 deductible, or now he has a $2,400 deductible and $5,400 max out of pocket. Okay, and so I don't know if you want to call this a tax per se, but it's certainly an expense. And I want to include it in your essentially marginal expense rate, if you will, if you want to classify it as that. And so that $7,600 withdrawal, one is taxed at 22%. Okay, because that's the bracket he was in. So he's going to owe $1,672 in taxes on that withdrawal. Okay, but he's also going to have that additional premium cost, $500 per month, $6,000 for the year. Okay, so right off the bat, if we just add those two together, he owes $7,672 in extra expenses from a $7,600 withdrawal. Okay, so he owes 101% tax on a withdrawal that he essentially forgot about. Okay, if he ends up needing out-of-pocket expenses and he uses up that whole max out-of-pocket range, it's going to end up that he's going to end up owing $3,000 extra on that front too. So he might end up owing $10,672 on a $7,600 withdrawal. And so obviously, again, in this situation, this person's marginal tax rate, their marginal expense rate, whatever you want to call it, is significantly higher than you will ever see. And so thinking about healthcare and in terms of your reported income as a tax can be extremely beneficial in order to make the right moves as you move through retirement. Okay. The other step up in healthcare costs is created by IRMA, okay, which would be Medicare penalties. Okay, so basically, this is a 2-year look back. So basically, what you pay for Medicare this year will depend on what you reported for an income in 2019. So it has a 2-year look back. But basically, the government will penalize you for reporting too much or making too much income. For a married couple, it's $176,000. For a single filer right now, it's over $88,000. You have additional expenses on Part B and Part D. Okay, and so basically, in each of these step ups, I laid out the annualized added expenses. Okay, and so these don't all add on to each other. This is basically from this initial cost. Okay, so if you end up being in this range over here, Okay, which means that you would make, again, over, for a single filer would be over 165,000, married would be 330,000. You will owe an extra $5,000 in Medicare expenses. Okay, well, we need once again to think about this in terms of a tax. Okay, it might make sense to convert now in order to avoid IRMA step-ups later, even if we're in what we would consider a high tax rate. Okay, if it's going to put us into this IRMA tax penalty later on. Okay, and make sure you don't forget about those RHTs. You know, you may know them as RMDs, but I know them as RHTs. It's required higher taxes. Okay. And basically these RMDs, once you turn 72, the government forces you to take money out, whether you need it or not. Typically this ends up with you paying more in taxes. So that's why I call it required higher taxes. Okay. So this is a common situation that we see. Someone's got a situation where they have done very well saving, investing for retirement. And they have a lot of their money in those IRAs, those 401ks. And so, after they turn 72, it turns into a situation where this orange line here is their income need. Okay. We see this green above this orange line. These are required minimum distributions. Okay. So in this person's situation, they're required to take more money than they need. That might push them up into additional tax brackets. Okay. It might push them into the Social Security tax trap, and they have no control over it. They have to take that RMD. If they don't, they owe a 50% penalty. So make sure you take your RMDs, even if it hurts, okay? Because if you don't, it will hurt much more, okay? And so this is something we often do for clients. Our software package essentially lays out these tax brackets visually over time. And so you see this drop down, these jumps right here. That's because of the Tax Cuts and Jobs Act expiring in 2026. And so as we can see, this 22% green line, and this 24% line, and then this 32% line. And we can see basically what these green RMDs do. Okay. They're in a situation early in retirement where they're bumping just on up into the 22% bracket. They might have $1,000 into the 22% bracket. Problem is, once RMDs start, not only it pushes them through the 22% bracket, but also pushes them into the 24% bracket. Okay. So let's say while working, they were in the 22% bracket. Well, this is why a forward-looking tax plan matters so much, okay? Because they might be working in the 22% bracket, and we might recommend a Roth conversion even at 22%. Why? Well, if RMDs later on push them into the 24% bracket, rather than contributing more to an IRA, or rather than leaving that money ride and just letting those RMDs be higher later, we want to convert at 22% in order to save at 24%. And in reality, because of the Tax Cuts and Jobs Act, we'd be converting at 22% to save at 28%, because this 24% bracket's turning into the 28% bracket. Okay, so again, your marginal rate, because of these tax hurdles, might actually be higher than you think. Again, your effective tax rate might still potentially be lower. Now, I will say that in some situations, because RMDs are so large, it makes a situation where even the effective tax rate is higher than while working, okay? But nonetheless, let's look at an RMD example. This person has almost $900,000 in RMDs. They're forced to take an RMD in 2021. This $35,000 RMD is money they don't need. Okay, so they're going to owe 12 and 22% tax on that RMD because that RMD is pushing them into the 22% bracket. Okay, so they're going to owe $6,275. It's also going to cause more of their Social Security benefit to be taxed. It's creating that Social Security tax trap we talked about. Excuse me. And so adding these two taxes together, they owe $11,600, which is a 33% marginal tax rate on that $35,000 withdrawal. Again, 33% is likely higher than any of you are paying in taxes right now, if you're still working. Okay. And so again, we need to be thinking about these marginal rates down the road in order to make decisions today. Okay. And they only are going to retain $23,000 of that $35,000. And this is only factoring in federal income tax, by the way. Okay. Another thing that most people forget about or don't readily think about is something called the survivor penalty. Okay. And the survivor penalty is while you're working, while you're married, I should say, you have essentially a little bit of a tax benefit because there's two people in a couple, so they give you essentially twice the amount of tax room in order to take income. So notice 9,950 is the 10% bracket for an individual. It's double that for a married couple. Okay, so while you're married, your RMD might put you into a situation where, yeah, maybe it bumps you up into the next tax bracket, but bumping up from 12 to 22% might not be the end of the world. Okay, so let's say you before the RMD, you have $80,000 of taxable income. And let's say that you have a $50,000 RMD. So that's going to push you up into that 22% bracket. While you're married, again, might not be that big of a deal. Okay, but what happens when one of you passes away? And obviously we have no idea when that's going to happen. So we want to stress test your portfolio in a bunch of different ways, looking at timings of, one person in that couple passing away at different times. But all of a sudden, okay, that person passes away. You still have the same RMD because the spouse is probably going to inherit your IRAs. So they're still going to have that same $50,000 RMD, but now they're going to be taxed at a less forgiving tax rate because they're going to be taxed the single filers rate. Okay, so let's say they need the same $80,000, okay, of income. Okay, so if they, as a single filer, if they need $80,000 of retirement income, they're automatically going to be in the 22% bracket, but that $50,000 is going to push them up into the 24. So before they were in the 12 and the 22, now they're in the 22 and the 24. Okay. The other thing to remember too, is that IRMA guideline as well. They might have not owed anything for IRMA because they were married. Well, if we remember that $88,000 mark is the first IRMA step up. Well, now that this person is a single filer, that $50,000 RMD is going to push them not only into the first IRMA, but also the second IRMA. And I see that Diane commented, don't forget about qualified charitable distribution. Yes, that's a great call. If you don't need that money and you have some charitable interests, okay, you can basically give this full $35,000 away in the form of a QCD. Basically what that will do is it will remove it from your taxable income. Okay, that charity will essentially receive that full $35,000. Government won't be able to get their hands on it. Now, that being said, you have to have an interest to give all of that RMD away. Obviously, some families do. Some families have a portion that they want to give away. But no, that is a way to basically keep the majority of that money going to a cause that you care about rather than the government taking a huge portion of that. So thanks for bringing that up, Diane. I appreciate it for sure. Finally, biggest concern essentially down the road is taxes might not be the same as they are now. So you might look at your situation and you might, because you might not have huge RMDs, might have a big Social Security benefit, might not need a ton of extra money on top of Social Security. You might look at your situation where, no, my taxes are going to be significantly lower in retirement. Well, what happens if taxes change? Okay, we are at historically low tax rates currently. Okay. Which is good. It might not feel like it, but yes, we are at historically low taxes looking back into the past. However, it's no secret to anybody that we are at historically high debt levels as well. And so the government can kick the can down the road much longer than any of us can think. This can go on for much longer. Things are completely fine right now. Government's paying all its debts. It's not having any issues. It's still being lent money by other countries. But at some point, they may need to deal with this situation. Okay, there's two ways the government can make money or pay off debt. They can add more debt in order to pay off their debt, which is, again, kicking the can down the road. That's not a real solution. They could theoretically spend less. Okay, that would be the one way. And then obviously the higher the taxes that we're currently paying would go to pay down the debt if we're spending far less, or we can raise taxes. Okay, and again, I'm sure there's a bunch of different opinions what's going to happen. I'm not making any predictions of where taxes are going in the future. We certainly don't build in, a guaranteed tax hike in the future in our plans. We run it as a stress test, of course, but we're not in the prediction game. Okay. That being said, taxes, I believe, are likely to go higher in the future. So if you're at a current tax rate right now and you're going to be at a slightly lower tax rate in the future, that might only be if taxes stay the same. If taxes go up, you might be at an equal tax rate, if not higher tax rate later on. Okay. And so again, I'm actually going to go to this next slide here. One tax hike that we do know about right now is the Tax Cuts and Jobs Act ending in 2026. Okay. If Congress doesn't do anything, they can extend this out. There's been a little bit of talk of even cutting this off before 2026, but they can extend it out. So we really don't know what's going to happen. But if nothing happens right now, it is set to expire in 2026. Well, what is this Tax Cuts and Jobs Act? What did it do? First off, it lowered each bracket by about 2 to 3%, and it raised the standard deduction. So once that sunsets, okay, essentially we are going to see higher taxes. So if you're even in the same bracket right now, let's say you're in the 12% right now, well, and you think you're going to be in the 12% when you retire, okay, well, it's actually going to end up being the 15% later on. If you're in the 22, it's going to be the 25 later. If you're in the 24, it's going to be the 28. So again, when you start thinking about RMDs, it might make sense right now, even if you're still working, to convert at 22% if those RMDs are going to push you into the 24 later on, because the 24 is going to become the 28. Okay. And so final reason that your marginal tax rate might be higher in the future is an inheritance from a parent or relative. And inheritance is an awesome thing. Obviously, none of us are turning away a nice inheritance from a parent or a relative. However, it might put you into a different tax situation. Okay, in 2020, Secure Act implemented the 10-year rule. If you don't know that much about the 2020 changes, I'd highly recommend looking at our beneficiary plan Wealth Wednesday we just did 2 weeks ago, I believe it was. Basically, what they did is they reset the rules for using up inherited IRAs, inherited Roth accounts, that you now have to use that money up within 10 years. Before you got to extend it out much longer, now you have to use it all up within 10 years. So let's say that you have parents that have done fairly well, okay, and you expect an inheritance between $500,000 and $1 million. Okay, well, that $1 million, let's say, just use round numbers, has to be used up within 10 years. Now you can take equal withdrawals from it for 10 years. You can take all of it in 1 year. It doesn't matter. You just have to use it all, withdraw it all from that account within 10 years. Well, that creates a situation where, okay, if we just, let's say we just left that money in cash, just to make the math simple, you have to take $100,000 a year. Okay, well, that's a situation where your taxes will for sure be higher than you previously thought, not without having that inheritance. Okay, so make sure you're thinking as well about what kind of inheritance will I get throughout retirement? When, obviously, we don't know when you might get that inheritance, but we should be thinking about it in the back of our minds and kind of stress test it at different periods. Because the last thing you want is to have a perfectly built forward-looking tax plan, and then it gets blown apart because you get an inheritance. And again, overall, that inheritance is good, but it can really mess up certain plans. Okay, especially if you have a Roth conversion strategy, you're planning on converting $100,000 a year. Now you have to take a $100,000 withdrawal instead from that inheritance. Okay, and so again, just additional things to think about. Getting that inheritance, receiving that inheritance at the wrong time can push you up into these higher brackets. Okay, best fix. What is the best fix for this all? Well, number one is to have a forward-looking tax plan in order to know what your taxes are going to look like throughout time, both your effective tax rate, but also what are the last brackets that you were taxed at? What is your marginal rate on that last money that you've taken out through time? Okay, because that's going to inform some decisions like Roth conversions, like withdrawals in given years. Okay, the best fix though is to have a diversified tax bucket. Okay, there's 3 types of tax accounts: taxable account, brokerage joint account, tax deferred account, and then a tax-free account. That would be a Roth. Okay, so in my opinion, the data backs this up. Your number one account over here is a Roth account for saving on taxes. Okay, a taxable account is second. The reason being is because that long-term capital gains rate is a preferential rate. Finally, because of RMDs, because of being taxed at normal rates, tax deferred bucket, I view as the third bucket. Now, if you have a ton of money in a tax deferred bucket, don't worry. There's a lot you can do to fix it. Okay, Roth conversions, again, a big concept that can make a big change. Okay, so in summary, this rule is, or this adage that we opened up with this webinar with, will your taxes be lower in the future? It's mostly right. Okay, it's mostly right when you're talking about your effective tax rate, but I'm here to tell you your effective tax rate doesn't matter nearly as much as your marginal rate when you're talking about saving on taxes throughout retirement and extending that money out past your lifetime. Okay, so make sure you know your marginal rate, not just your effective tax rate. Know it. So, for instance, let's say you get a plan built by an advisor, and they have a summary of what your tax rate or your taxes will look like. Your next question should be, okay, what do my marginal rates look like in order to add up to these taxes? So it might say $5,000 you'll owe in taxes, but a big portion of that $5,000 in taxes might be the last $5,000 you withdraw that was taxed at 40.7%. So ideally, you'd want to avoid that. It'll make again, you'd save in that example, 40% on $5,000, okay? So again, ask about your marginal rate, dig in on your marginal rate. Knowing what your retirement tax brackets look like is the single most beneficial planning tool as you move through retirement. Taxes will be your largest expense, so saving on taxes is the biggest change you can make, and it's a guaranteed change as well. We know the tax rates. We know if we save on taxes, that is a guaranteed return on our planning, if you will. Okay. Look out for the tax hurdles that can raise that marginal rate, from the tax trap to RMDs to healthcare costs to IRMA to all of the things that we talked about, to tax hikes. Okay. And then finally, make sure your current retirement advisor is focusing on your tax situation. You'll notice a lot of these Wealth Wednesdays, if not are focused on taxes, have tax elements into them. The reason being is because I think it's the number one thing an advisor, a retirement planner should be doing. So if you ask your advisor questions like, hey, what does my tax situation look like? Which accounts should I withdraw from? And they go, I don't know, I'm not a CPA, ask your accountant. That is the exactly wrong answer that you want. Okay. By law, an advisor is required to give you tax advice. They're required to know the tax code. Okay. That being said, they're not required to they don't replace a CPA. I think everybody should still have a CPA on the outside. Okay. But that advisor will know much more about what your situation is going to look like going forward in the future than your CPA will. So they need to be giving you that type of advice. If you're getting that common, I don't know, talk to your CPA answer, highly recommend looking for a second opinion. And taxes are complicated. Yes, they definitely are complicated. There's a lot of different levels. I think that's done I think that's done intentionally. Okay. It seems that over time, the government, rather than raising taxes, has implemented what we call a lot of stealth taxes. Some of these stealth taxes are created because they just add complexity to the tax code. Okay, so essentially they're on the top end, it looks like to everybody that taxes are staying the same, but they're adding all these complications on the back end to essentially hide extra taxes that you might be paying. So it seems to be a trend that Congress is moving forward with. They've moved forward with for the last 10 years. So yes, I 100% agree that they can be quite complex. If you guys have any other questions, if you're watching this replay, go ahead in the chat below. Feel free to throw in a question. I'll be more than happy to answer it. If it's more of a individualized, personalized question, you can go ahead and direct message me as well through my profile. I'd be more than happy to answer it, give you a little bit of extra confidentiality. You can also email me at eric@safeguardinvest.com as well if you have additional questions and want it out of the lurking eyes of Facebook. So anyway, thanks for watching. Thanks for attending. Hopefully you got a lot of good information on saving on taxes and why you might want to reconsider that common adage that taxes will be lower in retirement. Always remember, you don't need more money. you need a better plan, and you need a plan that updates through time, that updates and saves on those taxes, updates to those tax changes as well going forward in the future. So thanks a lot for watching. Everyone have a great rest of the day. Looks like Zoom ended up working, so that's awesome. All right, see ya, everyone.